Let me firstly introduce myself, as it is my first webinar at Forex Street. I'm the leading analyst at FBS. It is a worldwide recognized Forex broker. So I'll be doing these Forex webinars every week, and will get the weekly outlook for the Forex market. I'll call this program Forex Trading Plan, where we will analyze the weekly prospects for the main currency pairs, maybe some metals and commodities, and provide trade ideas and the framework for us to act in the weekly period of time. So I have prepared a presentation for you just to be able to learn the information better, and we'll also be looking at the Forex charts of the main currency pairs. So here is the screen, the presentation and our agenda for today. Firstly, I'll give you some tips on designing a trading plan, as it is a very important thing for weekly trades. Then we'll discuss the fundamental background of Forex market and switch to Forex currency charts and do the technical analysis. Finally, we'll get some conclusions of what we have discussed during this hour and name the trade ideas which will be mostly important and mostly interesting in this week. So let us begin. Some tips for designing a trading plan for the week. Firstly, I recommend you to study the market's risk sentiment and volatility. To do that, we of course study the fundamental picture, do fundamental analysis to understand what will be the logic of the market during the upcoming week, what would be the main market moving events, which pairs will be trading most, which pairs will be most volatile, and what economic events will be the main drivers. So if we see that most important events are, for example, from the euro area, then we will be trading the pairs containing the euro, and so on. Then we use technical analysis to determine the trends, the phases of these trends on different time frames to develop support and resistance levels, and design our agenda for the time period which we are interested in. I choose to act during a week. And then we design the so-called suggestions for the trade. We will, for example, hold position until a certain level is hit, buy or sell if some levels for the pair are activated, and get out of the market if the price went beyond some level which we have mentioned. I also would like to share with you an important tip from my point of view. It is very important to look at the weekly Forex chart at the start of the week, probably even better during the weekend. Then there is practically no trading on Forex market, because weekly charts sometimes can give us very valuable trading signals. Firstly, I look at the candlestick patterns on the weekly chart, and they provide important hints, as candlesticks represent simple but efficient analysis tool, and it kind of represents the logic of the Forex market and allows us to maybe spot some trade signals which we otherwise would have ignored. For example, let's have a look at well, euro dollar. We'll pick the euro dollar, look at the weekly chart, and see that here maybe not a very decisive signal from the candlestick point of view, during the last week, but still the pair was at the very important level of 100-week moving average. It failed to settle above this line, and in my opinion, this is a rather sizable bearish signal for the pair. Also, if we look backwards, study the chart's history, we also see that some big and distinctable candlesticks patterns on the weekly chart provide good signals, and these signals are very often reliable and give us a good idea of how to behave, of how to conduct our trade on the weekly basis. So these are the initial tips. We make trading plan for a week. It is a very good time frame. We look at the candlestick patterns at the weekend or at the start of the week for the pairs we trade in order to spot some hints from the price itself, from price action, which may be our first part of trade ideas of how to trade during the week. So this is a very, very good trading routine. Back to our presentation, and we now move to the fundamental background for Forex market. Firstly, I'd like to speak about the expectations for the Federal Reserve's policy. I think everyone understands that it is the main driver of Forex markets right now and probably always. But at the moment, of course, it is under the special focus of the market. Then we'll say a couple of words about the market's risk sentiment and commodity prices. In my opinion, these three factors represent the most important market moving forces during this week. So we now speak about the Federal Reserve and the US dollar. Here we have somehow I had a US dollar index chart. It has somehow disappeared, but well, okay, without it. We saw that US dollar index strengthened last week, and it happened after Janet Yellen, the head of the Federal Reserve, said that the case for an interest rate hike in the United States has strengthened in the recent months. Then the Yellen's vice president of the Fed, Vice Chairman Fisher, said that Yellen's speech is in line with 2 rate hikes this year, and this gave a big bullish driver to the US dollar. Of course, the market knows that the commands from the Fed may be misleading sometimes, not even sometimes, rather often. Often the Federal Reserve's members try to get some message to the market, but it doesn't mean that these are not only the words. It doesn't mean that the members of the Federal Reserve will actually act on their words and do as they say. So the market is rather skeptical, despite the fact that the possibility of the Federal Reserve's rate hike by the end of this year has increased according to the futures market. Still, it's rather low, around 50%, a bit higher, and we can't say that the market is truly pricing in even 1 rate hike this year for the United States. Today, commands from Fisher were more moderate. We didn't hear those market-moving lines from him anymore. And of course, once again, it comes back to the US economic data. US dollar is very sensitive to these releases, as these releases will form once again the market's expectations of the Federal Reserve's policy. We can see that there are some releases every day of this week actually, and even today in 20 minutes we'll get consumer confidence data for the United States. Then on Wednesday, there will be ADP non-farm employment change, Chicago PMI, pending home sales, and of course, crude oil inventories, the usual stuff we get on Wednesday. On Thursday, we will get the weekly unemployment claims data, ISM manufacturing PMI, very important indicators, and all these data releases surely are important for the US dollar. But the highlight of the week will be the release of US labor market statistics, average hourly earnings, non-farm employment change or NFP, and unemployment rate. These are all the releases for Friday. Why are these labor market data the most important? Because the Federal Reserve has the target of the labor market, and the Fed's policy is dependent on the results of American labor market. So even though the previous figures may be important, they won't be as important as this labor market data. And actually, my baseline scenario for this week is that US dollar will get stronger versus the major currencies, but they won't see big moves in the market until Friday and until a release of this non-farm payrolls report. So what are the scenarios for NFP? I think this is the question which interests us most. I have outlined some scenarios of the possible outcome and its impact on the market sentiment about the federal funds rate and the US dollar. Firstly, I'd like to point out that the consensus forecast is about 180,000 of new jobs in America. And this is, of course, less than the previous reading, a very strong reading of July of 255,000 jobs. But it is reasonable because we can hardly expect US economy to produce such big a number as we had in July, 255. This is really, really high, and we can remember that this was a positive surprise for the market. The consensus forecast is much more moderate, and if the reading is in line with consensus forecast, it will keep alive the expectations of the Federal Reserve rate hikes this year. However, we should remember that not only NFP will be released, there will be also data about average hourly earnings and US unemployment rate. So even though NFP may fall under some of these scenarios I have outlined, we will need to add data of average earnings and unemployment rate to make our picture, our scenario more full and for it to be more real and to reflect the real market situation better. Firstly, with NFP, I think that if American non-farm payrolls come below 100,000 mark, then it will be a big disappointment for traders. It will be a kind of repeat of a very weak data which US labor market produced in May. Then there was a big sell-off of American currency on this weak data. And if NFP comes below 100,000, then it will undo all commands of the Federal Reserve members, all the hawkishness about the Fed and the US dollar, and we'll see that traders will price out US rate hike this year, both in September and in December. And in the medium term, I think that will be another push to the upside for the risk assets, for the emerging markets and commodity currencies. So, and certainly a kind of blow to the US dollar, as traders will seek higher yields, higher returns in these higher risk assets. If we have a higher reading of NFP, but below 150,000, then traders will price out rate hike in September, but some expectations that in December the US Central Bank may actually raise interest rate will remain. This will hurt the US dollar, I think, versus all major currencies. Probably it will suffer more versus currencies like the euro and the British pound, because despite of the fact that there are expectations that the central bank will ease monetary policy, they already have done much, and the market may not expect much more from this central bank. I mean, the European Central Bank and the Bank of England. So this scenario just will lead to some decline of the US dollar, not a big sell-off, but still the US dollar will weaken. If non-farm payrolls come in range about the consensus forecast, somewhere between 150,000 and 200,000, then there will be no significant change in how the market is pricing in the US rate hike. We know that there are expectations of more than 30% chance that the US Federal Reserve will increase interest rate in September, and about 60% of the expectations that in December there will be a rate hike. So it will remain like that. The US dollar will have its support, but there won't be any new market moving forces which affect the US dollar and other currencies. So it is a kind of unchanged situation which will keep the uncertainty in place, and taking into account the fact that we won't hear much from the Federal Reserve speakers until the next meeting of the Federal Reserve, which will take place on September 21st, when the market will likely remain kind of sideways, and we won't see big directional moves in any of the currency pairs, I think. Just traders will be watching other US economic releases, but they won't be as important as non-farm payrolls. So as I think that no big moves will happen in this case. And finally, if we have a very strong non-farm payrolls, very strong is, in my opinion, somewhere around 250,000, maybe more. The more, the stronger. Then the traders will expect 2 rate hikes in the United States. They will think that the possibility of the rate hike in September is underpriced in, and it will be a bullish trigger for the US currency against all measures, of course, but here I've pointed out specifically a dollar yen and Australian dollar, US dollar. As for the dollar yen, here the market is really expecting that the Bank of Japan will ease monetary policy in September. Dollar yen, we saw got a rather good support around 100 yen mark. We will speak about it in more detail later. But just in general, we see that US dollar, Japanese yen wants a reason to get higher, maybe to try to change this downtrend, and it needs US data and the Fed's expectations for that. There are expectations from Japanese side, from the Bank of Japan. So together, this may produce a bullish reaction in dollar yen. I doubt that it will be a sustainable reaction just on non-farm payrolls, but still for some market sessions, we'll probably see a good upside move in case of such data from the United States. And bearish Australian dollar, US dollar, because I think that Australian dollar is overvalued at the current levels, and it is not in line with Australian economic fundamentals, so there is potential for a big move if US data provides a chance for such move. However, as I've mentioned a bit earlier, US non-farm payrolls is not the only release of the US labor market. We'll also get average hourly earnings, and there are reasons to believe that the growth of this indicator has slowed down in August due to some seasonal factors. So pay attention to this fact. This may diminish the positive impact from non-farm payrolls, even if it comes at good levels. And the unemployment rate, of course, is still an important indicator for US labor market as well. In my opinion, the most likely scenario among which I have mentioned is the scenario that NFP will come in line with consensus forecast, and maybe we'll get a bit weaker data for unemployment rate and average earnings. So US dollar won't get a big move from non-farm payrolls report. But all can happen. We know that non-farm payrolls is a very difficult thing to predict because analysts don't have this information that the US Labor Department has, and often even these consensus estimates are not very accurate. Often we see that there is a big divergence between the consensus forecast and what actually comes out as the non-farm payrolls reading. This is why this release is so important. This is why this release causes such volatile reaction of the market. So there can be many different strategies to trade on non-farm payrolls. I expect that we'll see that the market will be sideways ahead of the release, and you know that some traders try to set pending orders in order to catch the big move in the market, regardless of the side which this move will take. I think that maybe the less riskiest strategy will be to wait for the reaction of the market to the non-farm payrolls, and then to build positions for the next trading period. In our case, as we do these webinars once a week, this will be ideas for the next trading week. And as NFP is on Friday, this is actually a bit of rather convenient. In my opinion, we'll have the trading ahead on NFP as the main theme of this week, and then we'll digest the release in our next webinar, which will take place next Monday. So now I'd like to switch to the currency chart to speak about the technical prospects of currency pairs and a bit of fundamental factors for other currencies, but not the US dollar. Then there will be time for me to answer your questions if you have any of them. So here we can see the weekly chart of the euro dollar. We have discussed it already a bit, saying that last week the euro dollar ran into significant resistance created by 100-week moving average. Then we come to the daily chart, and here we can see also some varying signals. Some signals that we will see further declines of the pair. We can see that the euro dollar on Friday formed a bearish candle, which is actually a bearish outside engulfing candle, and is a rather strong bearish signal. The pair also closed below the support line, which is connecting July and August minimums, and now we can see that it is holding below the level of 100-day moving average, just above 1.12 mark. It is a line painted in green on this chart. So it is quite reasonable to expect further downside of the single currency versus the US dollar. However, in my opinion, this downside won't be very big. We won't see a big sell-off of the euro. We can see that the daily moving average, 100-day moving average, this 50-day moving average, and 200-day moving average are almost horizontal, which means that the general market lacks strong direction. It means that the pair is consolidating around these levels and won't make some really volatile moves. On the 4-hour chart, we can see that a kind of triple top was formed during the past 2 weeks, and the levels which used to be a support and around 1.1250 and 1.1230 represent now a significant resistance for the euro dollar. And I think that if an increase to these levels materialize in the coming few days, this area will be a good area to enter bearish positions for the euro dollar. We can see that the pair has support. Support is at 1.11 mark. This is actually 50-week moving average at the weekly chart. So this is the target I have as for selling the euro, as I think that it may be hard for the bears to overcome this support area. So here is our working range for the euro dollar this week is 1.1250 and 1.11. Probably not much, but I am continue sticking to the view that we won't see very strong, very volatile moves. So we will trade on the breakthrough of this support line at 1.1150. Here is 200-day moving average at the 4-hour chart. I find that the combination of these moving averages, 200 period, 100 period, and 50 period works the best. at actually all price timeframes for Forex measures, as these are the main lines followed by most of the traders. And here market psychology plays its role, because if all traders see these important lines, then they react to these lines, they build their trades on the basis that the pairs will either recoil from these lines or break these lines. In any case, traders do notice these lines, so they are really important, and they do provide good hints for the market. All in all, I think that the picture for the euro dollar is quite clear. If you already have short positions for the euro, you may hold them ahead of the US data on Friday. If you don't have them, then look for more attractive levels, either higher in the resistance area I've mentioned or on the break of support. I think that it would be better to close positions ahead of NFP release, just ahead of this on Friday, or when the euro dollar hits this target area of 1.11, and then to conduct another set of market analysis, another set of technical analysis. As for the fundamental picture for the euro, it lacks the fundamental strength of its own. There will be data from Germany this week. Germany will release inflation figures today. So far, data from different regions of Germany showed that consumer prices have either contracted or haven't changed. So I think that the overall reading for German CPI will be also weak. And this might have an impact on the euro area's consumer prices, which will be released on Wednesday. So European factors don't support the euro as well, in my opinion. Euro is currently correlated positively with the market risk sentiment. So maybe there will be some hints for the euro dollar from that, but of course the theme of divergence of the European Central Bank and the Federal Reserve's monetary policy should be the main driver of the euro dollar, at least until Friday, until non-farm payrolls. If, as I expect, we don't get any clear signal from non-farm payrolls that there will be a rate hike in September in the United States, then the euro might find support in the mentioned levels around 1.11, maybe a bit lower in the 1.10 area. As we can see that all in all, the euro is rather resilient despite the easy monetary policy of the European Central Bank. It is partly caused by the fact that the euro area has a big current account surplus. European banks with their troubled balances now don't export capital much, and this creates this diminishes monetary outflow of the euro area, creates monetary inflow and support the euro, and this situation is not going to change fundamentally. So if we don't get a serious signal from the monetary policy divergence, then the euro dollar may stick to this support levels around 1.11 and continue its sideways trading somewhere between 1.10 and 1.12 in the coming weeks. But for this week, I have outlined the prospects. We move to the British pound US dollar pair. Here we can see that the dynamics of the pair is the triangle. Yes, we have this resistance line, which has several times stopped attempts of the bulls to retrace higher after the big decline which happened after Brexit vote. And this consolidation is expected to continue for the British pound. All in all, last week we saw that data from the United Kingdom is not as bad as some analysts and experts have feared. It seems that Brexit didn't hit the UK economy as much as feared. And all in all, British pound, despite the weight of the general downtrend, despite the weight of Brexit uncertainty, has some support. Here at this chart, I have the pivot points multi-frame indicator applied. We can see it as the resistance and support levels. This is the weekly indicator, and I find it very useful. You can see that the pair is trading below the weekly level of, let me see it. The weekly pivot level is at 1.3147. We are below this level and at the bearish territory. The first weekly support is located at 1.3018. 1.30 is a key level for British pound US dollar, and I expect that there is potential for the British pound to get to this level, but this may be a rather strong support, and it may actually limit the decline. The next support is at 1.29, the weekly support, and also the support area of this 2-month triangle. So this is the next stop in case British data keeps disappointing this week. We have the release of British PMIs, and actually there are reasons to believe that this data will disappoint. Manufacturing PMI was weak in July and is likely to come below the 50-point mark, which marks the industry contraction, also for August as well. So if this British data come negative, and if US non-farm payrolls come rather good, then we'll get probably a chance to test levels below 1.30, but at 1.29 I would certainly close my bearish position for the British pound, because I believe that the pair doesn't have momentum to get lower. This is the support of the triangle. Also, we can see that the daily MACD indicator is rising, so it doesn't correspond to the strong move to the downside in British pound. So 1.29 is my big stop for short trades in British pound. One look at the 4-hour chart. Here we can see that the pair lacks momentum in the short term. We are trading around 1.31 level. On the 4-hour chart, the moving averages are horizontal, so it favors sideways trading somewhere between 1.3180 and 1.30. We have spoken already about 1.30 mark, that this is significant support, and resistance at 1.31, 1.32 is the resistance area. Here we have the temporary top, which was formed last week. So the pair has to overcome this level to get a chance to test higher levels around 1.33. I think that the British pound this week doesn't have bullish drivers of its own. And if any increase happens, it will be because the US data disappointed and, well, didn't live up to the market's expectations. So look for increase to 1.3180 to build new short positions, but be careful with your sell targets. Mind 1.30 level and as I have already told, 1.29 level for the big moves in this currency pair. Of course, traders think that many analysts and traders actually think that the Bank of England may continue reducing interest rates at the upcoming meetings. For now, I think this is not a big driver of the Forex market. We don't see any commands from the Bank of England which would move the market. So I don't think that this week is very important. Here, all we have is US Nonfarm Payrolls, and regrettably, the volatility will may be low ahead of this event in pound dollar. So probably this is not my favorite pair to trade this week. Dollar yen may be more interesting. We can see that at the weekly chart last week, the pair managed to stay above the recent lows, and despite the fact that it went lower, it managed to close the week on a very positive note, forming a kind of temporary reversal and providing the pair an ability to recover a bit higher and to correct to this long-term downtrend line. Of course, on the weekly chart, we can see clearly that the general downtrend is still in place, but we can see that there is scope for more correction to the upside, and this is our working thesis for this week. On the daily chart, we can see that the pair continues to grow. It is maybe getting a bit at high levels, but there is still a possibility to rise to the levels of 103.50 and 104. This is the resistance area for this pair. Some resistance is located at 102.70. This is 50-day moving average, and it is trying to stop the bulls a bit. But I think that long positions can be made even at the current levels, targeting 103.50. But I'm afraid that we are not able to bet on the fact that this trend will be broken this week. Only if an extremely bullish scenario, an extremely good MVP above 250,000 comes, then maybe. For now, the pair is supported by the expectations that the Bank of Japan will ease policy in September, by the expectations that US NVP may come rather well. So the scenario is bullish for the coming sessions. We still have some pips here to catch on the upside. There are commands from Japanese monetary authorities. As usually, they claim that they are ready to intervene in the currency market to limit excessive appreciation of Japanese yen. But taking into account the fact that the pair has found rather good support around 100 yen per dollar mark last week and staying above 100.70. This is the 50% Fibonacci retracement of dollar yen's advance from 2011 to 2015. Several times we have stayed above this mark. So I think that the current levels are rather high. and there is no need to be afraid of some monetary policy intervention from Japan. Let us move to Australian dollar, US dollar. We here, as always, start with the weekly chart. And at the weekly chart, we can see that several attempts of the pair to break above this long-term resistance line have failed. We can see that these weekly candles have significant upper shadows, that last week the pair went below and closed below 100-week moving average in the area of 0.76. So the picture looks pretty bearish to me. Also, we look at the weekly indicators. Here, bearish is the word I can use to describe the prospects of Australian dollar this week. In the daily chart, we can also see that the pair breached a support line, which was drawn through July and August minimums. And despite this bullish candle, which was formed on Monday, a kind of hammer candle, the pair is still declining today. And the levels to target are 0.75. If we have rather strong non-farm payrolls reading, I think that the pair will be vulnerable, maybe vulnerable to test levels around 0.74, as I believe that Australian dollar is overvalued, and the general dynamics is that we need to test this 200-day moving average and this support line which connects minimums of 2016 for Australian dollar, US dollar. Still, to make this trade to 0.74, perhaps we will need more confirmation below 0.75, as at 0.7490, so around 0.75, we have the top of the weekly Ishimoku cloud and also the line of the Ishimoku cloud at the weekly chart. This means that here we will have support level. Also, this is roughly the minimum of 1 week at the end of July. So maybe this is the first bearish target, and here the pair will make a stop. So to expect further decline in Australian dollar, US dollar, despite this bearish formations at the weekly chart, we will need a confirmation, at least a daily close below this level of 0.7490. I recommend take this level, not just 0.75, the round figure, but 0.7490, just to be sure that the bigger move to the downside is coming. I think that there is a chance, pretty good chance that this will materialize, but it was never bad to be too cautious, I think. And just maybe a couple of words about some other currency pairs. New Zealand's dollar, the weekly chart shows that serious resistance is at 0.7360. Bearish candle at the weekly chart. Of course, sometimes bearish candles don't offer us the decisive trade signals, but we may see more downside ahead of US Nonfarm Payrolls report, and 0.72, 0.7150, the next important levels here. Big support for the medium term is at 0.7050. US dollar, Canadian dollar, we see here increase, and the pair is above the key level of 1.30. I'm sorry. Weaker oil prices are in favor of the US dollar, and I think that ahead of non-farm payrolls, we may try to test higher levels. We will watch Canadian GDP on Wednesday. It will surely give us more hints about the strength of Canadian dollar, but I think that here we have some bullish potential, at least the small one, for the levels of 1.31, 1.3150. Also pay attention to the fact that Forex market in the coming days will be affected by the month-end rebalancing flows. And there are reasons to believe that at the month end, at the last day of this month, it means on Wednesday, August 1st, we will see more demand for the US dollar and probably Japanese yen. So these month-end flows are in line with scenario that we will see moderate strength of the US dollar versus the major pairs this week. As for the metals, as for gold, we see that it is currently at the edge of support line around 1.1315, and of course the level of $1,300 an ounce of gold is an attractive level for the bears. If US Nonfarm Payrolls come strong, then here we go. If not, then the upper border of this triangle will be the area on which the market will be focused. And I have two more pairs. US dollar Swiss franc is rising in line with the fact that the euro dollar is falling. These two pairs have an inverse correlation. All in all, here we have a range and resistance at 0.9830. This is a 200-day moving average, but there is potential for the US dollar to get higher to the area above 0.99, to the upper border of this range. We'll see whether the pair will manage to overcome this obstacle of 200-day moving average. It will certainly depend on NFP. And Euro British Pound currency pair, here I think that will get a modest decline to the support area around 0.8445. Here the pair needs correction. We can see my MACD divergence on the daily chart. So small declines are favored, but the general uptrend here remains in its place. So this is it. This is the picture for the main currency pairs. Maybe you do have some questions I can answer for you. Maybe you have questions about what I have taught today about the weekly outlook and the trade ideas. You can post your questions in the chat window. I'll answer them. And now a brief conclusion of the things we have spoken about today. So the main driver of the market right now is what the market expects about the Federal Reserve. It is the main driver after comments from Janet Yellen, the Fed's chair, and the Vice Chair Stanley Fischer at Jackson Hole last week. Their comments were hawkish and led to an increase in expectations of the Federal Reserve's rate hike at September and December meeting. At September, the expectations are rather low, at December higher. But for now, we can say that the market isn't pricing the rate hikes in the US fully. The further dynamics of the US dollar will largely depend on the release of US Nonfarm Payrolls data on Friday. The consensus reading is 100,000, and this is a rather good reading. If we have a reading in line with this consensus, then the US dollar will have its support, but the market will lack new drivers and trading will remain sideways. Ahead of the release of non-farm payrolls in the coming next days, trading should remain in favor of the US dollar. I'm mildly bullish for the US currency versus their main currency pairs in euro dollar, in British pound US dollar, dollar yen, Australian dollar US dollar. These are the pairs where you can trade buying the US dollar and constantly selling the other major currencies. The targets should be rather moderate. It's 1.11 for the euro dollar, 1.30, maybe 1.29 for British pound US dollar, 103.50, 104 for dollar yen, and 0.7490, 0.74 for Australian dollar, US dollar. Probably the dynamics of the main currency pairs this week won't be very volatile, so we'll have to deal with maybe not big moves of the main Forex currency pairs, which will happen. So no big moves are expected ahead of NFP release. Then we'll get NFP reading and probably the new reality of the Forex market, or the uncertainty which we are dealing with may just remain in place. As I don't see any questions, I hope that my presentation today was clear. And welcome to our next webinars with Forex analysis and outlook for the upcoming week. The webinars will take place every Monday at 12 p.m. GMT, where we will design our trading plans for the upcoming weeks. So thank you for your attention, and I wish you profitable trading, successful trade ideas, and just all the best today, and see you next Monday. Thank you for your attention.